In this episode of the MSA Rental Market Update, we are looking at the Kansas City rental market for conventional multifamily properties. I am David Monroe, CCIM, and if you'd like to continue to see these videos, please make sure that you subscribe to the channel, like and share these videos, and I will continue to do these rental market updates. I know I've slowed down quite a bit. Things have gotten really busy. I am trying to do about 2 or 3 a week, though I haven't done one in a couple of weeks. So we'll try and pick that up a little bit. So let's take a look and see where the Kansas City metro statistical area is. And you can see that it is drawn out here in CoStar, which is the tool I use to do these rental market updates. We will see that it is next to Topeka, Kansas. Des Moines, Iowa is up to the north. We've got Chicago, Illinois to the northeast, Indianapolis to the east, Louisville to the east, of course, St. Louis, and the eastern part of the state right along I-70. If you were to scroll up just a little bit, you'd find Tulsa and Oklahoma City right down here. So now that we know where it is, let's take a look at the filters. And as usual, we are excluding all corporate, military, senior, and vacation. And we are only including market and market affordable so that we are only looking at conventional apartments. Looking at location, you can see that we are in market, metro statistical area, and Kansas City, Missouri. So let's go take a look at the analytics and see what the supply snapshot shows us for the Kansas City metro statistical area. So here is our supply side snapshot. We have 2,777 properties in the metro statistical area, totaling 178,273 units. There's currently 9,389 units still under construction, and in the last 12 months, 2,475 more units were rented than went vacant. In the previous 12 months, it was 6,668 more units that were rented than went vacant. So an extreme slowdown in absorption. The vacancy shows us that, as we had 6.4 12 months ago, and today it is at 7.9%. There was a year-over-year increase of 4.6%. We will see what it looks like quarter over quarter. And we are not looking at the capital markets. We are only looking at the space market. If we scroll down, we will see that our long-term occupancy average over the last 22 years likes to be at about 91.5%, and it's currently sitting on about 92%. So just barely hanging above that long-term occupancy average. When we get to the end of this video, I will pull up the market cycle chart, and we will plot on the market cycle chart where we believe the Kansas City metro statistical area is in relation to the long-term occupancy average for the first quarter of 2023. So that said, let's go take a look at the data analytics and see what that is telling us. So here is the rent analytics for all asset classes combined. We do not look at asking rent. We don't care what the owners are asking. We only care what they are collecting. If we go back to first quarter of 2022, it was at $11.47 a month, went up to $11.92, was stabilized in third quarter from second quarter to third quarter at $11.91, went down a little bit in the fourth quarter to $11.85, and then had this jump, actually pretty considerably between quarters, in the first quarter of 2023. We are not looking at year to or quarter to date for second quarter. The data is too young and is erroneous to this date. So let's see if absorption tells us we should have seen this jump, or if it was erroneous because we've got a lot of owners that may be in trouble because their NOIs are falling below their minimum required debt service coverage ratios. So if we look at deliveries, we can see that 1125 was delivered in the first quarter and 1870 absorbed. Good, strong absorption, more units absorbed than delivered. Then we had 818, and again, a great showing, almost double absorption than what was delivered. Then things start to slow down considerably. 1175 delivered, only 750 absorbed. And then things go negative. Another 1,714 are delivered vacant to the marketplace, and an additional 309 more units go vacant. The fact that we only had a $5 decrease in rents is a little disconcerting because we can see that the occupancy since the second quarter has been declining steadily. And the fact that we had this 0.5% decline from fourth quarter to first quarter 2023, yet we saw that big jump in rents, means that the owners just erroneously or at their own will decided they were going to raise rents. There was definitely not demand to do so. There was some absorption, but was half of what was delivered. That is not good absorption at all. And that slowing and decrease in occupancy shows that. So we were following demand supply principles for the first few quarters through 2022, and then demand supply principles went out the window as we entered 2023. So let's see what each individual asset class shows us. So here are the rent analytics for the Class A properties in the Kansas City metro statistical area. There are 164 properties totaling 38,253 units. Looking at effective rent, first quarter 2022, they were at $1,462, went up to $1,438, then down to $1,522, down to $1,493, and then up to $1,520. Let's see if demand supply principles hold, or if we saw what we saw in the overall. So we can see that there were some deliveries to the Bs. Here were the A's deliveries. So 429 delivered and more than double absorbed. Very good absorption. 633 delivered and then only 761. I say only. Then we had a good strong absorption of 761 because we had more absorbed than delivered. Third quarter, 263 delivered, 397 absorbed. Again, good, strong showing on absorption. And then we had 762 deliver and only 5 absorbed in the fourth quarter. Now, you could argue here that this could have been due to the fourth quarter being the slowest quarter of the year. But notice we saw that negative absorption in the overall asset class. I think we're going to see that may follow in the C's. I haven't seen the data, but that's just a guess of mine. So even though we had this slowing, we actually had a jump from 208 to another good, strong absorption. So in the Class A market, demand supply fundamentals seem to be holding here, where this does justify that rent increase. Probably shouldn't have seen a rent decrease in the third quarter, but we did. And we would have seen the decrease in the fourth quarter as we did. But from the fourth quarter to the first quarter for Class A's, we had that rent bump, and the absorption says we should have had that. So Class A demand supply fundamentals, you're operating as advertised. Now keep in mind, you're only at 91.9%. So pay attention, there might be a quiz later. Don't allow this to fall much further. You are going to need to do something with these rents, but as we've seen, so far it's following fundamental principles. Let's go see what the Class B story is telling us. Here's the Class B rent analytic data. There are 691 properties in the market totaling 66,764 units. Looking at effective rent, if we go down to first quarter of 2022, it was at $1,166, up to $1,213, stabilized at $1,213, down to $1,208, and then up to $1,223. Let's see if demand supply principles hold, as it did with Class A. So here are the remaining of the deliveries for the units that we saw in the overall asset classes. 696 delivered in the first quarter of 22, 988 absorb. Good, strong absorption. 185 deliver, 822 absorb. Huge absorption on that one. 912 deliver in the third quarter, only 623 absorb. 952 deliver and only 23 absorb. So same thing that we saw with the Class A's. Fourth quarter of 2022 was really, really weak, and we saw that decrease in rents because of it. But remember, we saw that big jump in rents from fourth quarter to first quarter 2023, yet we had 1,387 deliver and only 379 absorb. We actually dropped 1.3% in occupancy from fourth quarter to fourth quarter 2022 to first quarter 2023, yet we had that huge rent bump. That is not demand supply principles. That says these owners raised rents because they either needed to or thought they could. All right, this is not good. You don't do this, but they did. So we'll see how it'll affect them moving forward. Now, they are sitting right on the edge of where they can get agency financing if they need to do a refi. So you better start paying attention to your occupancy and adjust those rents appropriately to bring this occupancy level up so you can get out of these bridge debt situations that a lot of these owners might be in. So that's the story for Class B. Let's go see what Class C is telling us. So here's the Class C rent analytic data for the Kansas City metro statistical area. There are 1,735 properties in the market, totaling 72,627 units. As usual, looking at effective rent, started the first quarter 2022 at $925, went up to $950, up to $958, up to $964, up to $977. But you know what? I'm going to be willing to bet that when we get over to absorption, because you shouldn't have deliveries in Class C properties, that we're going to see negative absorption in just about all these quarters. Anybody want to bet? Let's take a look. I haven't seen it. Well, not all of them, but 3 of the 5 quarters are showing negative absorption. Now, let me caveat this. You are at 93.6 or 93.4 going into the first quarter of 2023. So I'm going to caveat that and say that the occupancy is a little higher than it should be. And so we can't discredit the owners in the Class C space for continuing to raise rents because they are trying to bring the occupancy down to a stabilized occupancy rate. They obviously don't want to go down below 90%, but they are still in a range where they can raise rents. So I'm not going to fault them for raising these rents, but we can see that other than the first quarter of 2023, which we saw that big jump in January, there was a big feel-good of what was going on in the economy in January, and we saw a big jump in renters re-entering the market in January, which of course slowed and then went negative again as we went into February and March. But as we look at this, we can say that rental demand has pretty much tanked in this market for Class C properties. All right. So that is the story of Class C. Again, didn't really follow demand supply principles, but again, with the occupancy being as high as it is, I don't blame them for continuing to try to raise rents. So where does this market sit on the market cycle chart? Well, remember, the market likes to be about 92%, and we were about 0.5% above it. So we could place it right here along this long-term occupancy average. We are definitely seeing a slowdown in absorption, negative absorption in the Class C. We have seen negative rent growth in 2 of the 4 quarters or 5 quarters in A and B. And of course, Class C has continued rent growth primarily because its occupancy is still a little high. So we can argue that Class C might be up here and A and B may be here on the long-term occupancy average in between oversupply heading into recession. But I think another quarter or 2 will tell us where Kansas City's going. But overall, Kansas City's not too bad. It's definitely slowing, but we're not seeing the big drops in rents like we've seen in some of the other markets. So that does it for the Kansas City metro statistical area. If you found this video helpful, please like it, please share it. Don't forget to subscribe and ring the little bell so you're notified every time I do one of these. I also have the new how-to series, so don't forget to go check out my how-to playlist where over the last few weeks I've started putting in some short how-to videos and then of course some longer master classes as well. So I look forward to continuing to bring value to you guys. If you ever have any questions or want to see something different, let me know and we'll see if we can do something. All right, we'll see you in the next market.